Why is saving your first $10,000 so incredibly hard? It feels like a milestone that's always just out of reach. If you're struggling with this, I want you to know you are not alone, and it's probably not your fault. We're often told to just cut back on lattes or cancel a subscription, but the real reasons are much bigger and more systemic. Let's break down the hidden barriers that keep so many Americans from building that initial nest egg. First up, the elephant in the room: wage stagnation. For decades, the average worker's paycheck has barely kept up with inflation. Think about it, the cost of everything, from groceries to gas, has skyrocketed. But wages have crawled along at a snail's pace. This creates a massive squeeze. When your income is barely covering your basic needs, the idea of setting aside a significant amount for savings feels less like a choice and more like a fantasy. It's not about poor budgeting. It's about a fundamental mismatch between earnings and the cost of living. Next, let's talk about the big three expenses: housing, healthcare, and education. These aren't luxuries, they're necessities, but their costs have exploded. Rent in many cities eats up 30, 40, or even 50% of a person's take-home pay. That's before you even think about food or transportation. Then there's healthcare. An unexpected medical bill can wipe out years of savings in an instant, even for those with insurance. And student loans. Millions are starting their careers already deep in debt, with monthly payments that feel like a second rent. When these three sectors demand such a huge chunk of your income, what's left for savings is often little to nothing. Another major factor is the shift away from stable, long-term employment. The rise of the gig economy and contract work means less job security and fewer benefits. Gone are the days when a company pension and a gold watch were the norm. Now, many people are juggling multiple jobs just to make ends meet. Without access to employer-sponsored retirement plans like a 401k or the matching contributions that help savings grow. This precariousness makes long-term financial planning incredibly difficult. You're constantly in survival mode, focused on this month's bills, not a savings goal that's years away. Finally, our financial system itself isn't always set up to help the little guy. High-interest debt, like credit cards and payday loans, can become a trap that's nearly impossible to escape. Banks often have high minimum balance requirements or fees that penalize those with less money. It creates a cycle where being poor is expensive. You're penalized for not having enough money, which makes it even harder to accumulate any. So, what's the takeaway? Saving that first $10,000 is a huge challenge, not because people are lazy or bad with money, but because the economic deck is stacked against them. Understanding these structural issues is the first step. It helps us shift the conversation from individual blame to finding collective solutions. Let's advocate for better wages, more affordable living costs, and a financial system that works for everyone. Thank you so much for watching. If this resonated with you, please hit that like button and subscribe for more content that dives deep into the real economic issues affecting our lives. See you in the next one. Have you ever felt that buzz, that excitement to start investing, only to be stopped in your tracks by a big question: where do I even begin? It feels like everyone else is already miles ahead, making money in the stock market, while you're still on the starting line. I've been there, and trust me, that feeling of being overwhelmed is completely normal. The good news is, the most important part of investing doesn't start with a $1,000 deposit. It starts with $0. That's right, zero. Today, we're talking about the crucial preparation you need to do before you invest a single cent. This is the stuff that separates successful long-term investors from those who get spooked and sell at the first dip. Stick with me, because by the end of this video, you'll have a rock-solid foundation that will give you the confidence to start your investing journey the right way. So, what is this magical $0 starting point? It's all about building your financial house on solid ground. You wouldn't build a house on quicksand, would you? The same goes for your finances. The first pillar of this foundation is understanding your current financial situation. I know, budgets sound boring. But think of it less like a restriction and more like a GPS for your money. You need to know where your money is coming from and where it's going. Grab a notebook, open a spreadsheet, or use a budgeting app. It doesn't matter how you do it, just do it. Track every dollar for 1 month. Your morning coffee, that subscription you forgot about, everything. You will be amazed at what you find. This isn't about judging yourself. It's about gathering data. This data is your superpower. It shows you exactly where you have opportunities to free up cash for your future investments. Once you have a clear picture of your cash flow, the next step is tackling a common enemy: high-interest debt. I'm talking about things like credit card debt, which can have interest rates of 20% or even higher. Think about it this way. If you're paying 20% interest on a credit card, you would need to earn a 20% return on your investments just to break even. That's an incredibly high bar, even for the best investors in the world. Paying off this kind of debt is one of the best guaranteed returns you can ever get. It's like giving yourself an instant, risk-free profit. So, before you rush to buy stocks, create a plan to aggressively pay down any high-interest debt. The two most popular methods are the avalanche method, where you pay off the highest interest rate debt first, and the snowball method, where you pay off the smallest balance first for a psychological win. Choose whichever one motivates you more and get started. Clearing this hurdle will free up your financial and mental energy to focus on building wealth. Now, for a step that's non-negotiable: building an emergency fund. Life is unpredictable. Your car might break down, you could have an unexpected medical bill, or you might face a job loss. An emergency fund is your financial safety net. It's a stash of cash, separate from your investment accounts, that's easily accessible for these oh-no moments. Without it, you might be forced to sell your investments at the worst possible time, like during a market downturn, just to cover an unexpected expense. This is a classic rookie mistake that can derail your long-term goals. So, how much do you need? A good rule of thumb is to have 3 to 6 months' worth of essential living expenses saved up. This includes rent or mortgage, utilities, food, and transportation. Keep this money in a high-yield savings account where it's safe, liquid, and can earn a little bit of interest. It might take time to build this up, and that's okay. Start small, automate your savings, and celebrate your progress along the way. Having this cushion will give you incredible peace of mind and allow you to invest with confidence, knowing you're prepared for whatever life throws at you. Okay, your financial house is getting stronger. You understand your cash flow, you have a plan for debt, and you're building your safety net. Now we can finally start thinking about investing itself. The next $0 step is education. The world of investing is filled with jargon: ETFs, mutual funds, index funds, diversification, asset allocation. It can sound like a different language. But you don't need a PhD in finance to be a successful investor. You just need to learn the basics. Start by reading reputable books on personal finance and investing. I recommend classics like The Simple Path to Wealth or The Little Book of Common Sense Investing. Follow trusted financial creators here on YouTube or listen to podcasts. The goal here isn't to become an expert overnight. It's to understand the fundamental principles. Learn what a stock is, what a bond is, and why diversification is so important. Understand the concept of risk and reward. The more you learn, the less intimidating it all becomes. This knowledge is your shield against bad advice and risky get-rich-quick schemes. With some foundational knowledge under your belt, it's time to define what you're actually investing for. This is a deeply personal step. Are you investing for retirement in 30 years, a down payment on a house in 5 years, or maybe for your kids' education? Your goals will determine your entire investment strategy. Why? Because your timeline or your time horizon dictates how much risk you can afford to take. If you're investing for retirement decades away, you can generally afford to take on more risk because you have plenty of time to ride out the market's ups and downs. But if you need the money for a down payment in just a few years, you'll want a much more conservative approach to protect your capital. So, get specific. Write down your goals. How much do you need, and by when? Having clear, written goals will keep you motivated and focused. It turns investing from an abstract concept into a concrete plan to build the life you want. Now that you have your goals, you need to understand your own personality as an investor. This is your risk tolerance. Are you the kind of person who would panic and sell everything if the market dropped 20%? Or would you see it as a buying opportunity? Be honest with yourself. There's no right or wrong answer. Your risk tolerance is a combination of your financial ability to take risks like your job stability and emergency fund and your emotional willingness to do so. Many online brokerage platforms have free questionnaire that can help you gauge your risk tolerance. Understanding this about yourself is critical because it helps you build a portfolio you can actually stick with. If you create a portfolio that's too aggressive for your comfort level, you're likely to make emotional decisions that hurt your returns in the long run. The best investment strategy is the one you can stick with through thick and thin. So, let's recap the $0 prep work. You've audited your finances, made a plan for high-interest debt, started your emergency fund, educated yourself on the basics, defined your goals, and assessed your risk tolerance. You've done all of this without investing a single dollar. Yet you are now light years ahead of someone who just randomly throws money at a hot stock they heard about. You've built the foundation. Now, and only now, are you ready to think about opening an investment account? There are many great low-cost brokerage firms out there. Do some research and find one that suits your needs. Look for low fees, a good selection of investment options like low-cost index funds and ETFs, and a user-friendly platform. The initial deposit can be as little as $1 or whatever you're comfortable with. The amount you start with is far less important than the habits you've built. Remember, investing is not a sprint. It's a marathon. It's about consistency and time in the market, not timing the market. By taking these preliminary steps, you've set yourself up for long-term success. You've replaced fear and confusion with knowledge and a plan. You've taken control of your financial future. This preparation is the most valuable investment you will ever make, and it costs you nothing but your time and attention. So go ahead, build that solid foundation. Your future self will thank you for it. Thanks so much for watching today. If you found this helpful, give this video a like and subscribe for more content to help you build wealth with confidence. I'll see you in the next one.